Great. Well, good evening. I'm Opal Elliott, a volunteer community ambassador with AARP Virginia. Welcome to AARP Virginia's retirement planning webinar, and thank you for joining us. This program is scheduled to run for 80 minutes, but we may finish a bit early depending on how many questions you submit. So I'll be joined today by my friend and colleague, Trudy Morato, one of the AARP Northern Virginia Community Ambassador volunteers, who will field all of our questions at the end of our session today. So AARP really believes that preparing for our financial future is all about achieving a concrete financial milestones that make sense for us, nobody else but us. Even if these milestones are very modest, each one makes our financial future bright and more secure. So we really do applaud you for deciding to spend time with us this Tuesday evening. It's a beautiful day here in Northern Virginia. You could be outside enjoying yourself, but you chose to be with us this evening, thinking about and planning for your financial future. Retirement planning doesn't have to be daunting, although sometimes it's billed that way. In this evening's program, you'll learn some tips for determining if you are on track and learn practical strategies to help you achieve retirement peace of mind. So in the reminder email for today's session, we included a link to download the slide presentation and a link to the resource page listing all the websites that we'll share this evening. So I am thrilled to be joined this evening by Pamela Sams. Like me, Pamela is also an AARP Virginia volunteer community ambassador, and we're so fortunate to have her on our team. She's the head of our dream team, we like to say. Pamela is a chartered retirement planning counselor, and she spent the last 20 years helping people improve their personal financial wealth through solid financial life planning. Pamela is a strong advocate for financial literacy, and she voluntarily conducts financial education seminars and role this evening, not specific advice or recommendation, but hopefully the information we cover and the resources we share will help you make informed decisions about your financial future. So with that, please give a warm Zoom welcome to Pamela Sams. Pamela, the screen is yours.
Thank you very much, Opal, and thank you very much, Trudy, and the Dream Team. Hello, my name is Pamela Sams, and I am a community ambassador for AARP. People were putting in the chat where they were from. I am AARP Virginia, but actually I am on travel at a financial planning conference for the past few days. So I'm actually in Boston streaming to you today. So it's actually pretty nice out here as well. But I do look forward to facilitating tonight's conversation about retirement planning with you because it's a very, very important topic, as Opal had mentioned. Remember, again, this presentation is intended to provide the general guidance, not specific legal and/or financial advice. Individual circumstances may differ, and it should be taken into consideration before acting. As Opal had mentioned, I am a financial planner and financial expert. I cannot, however, provide any individual or specific advice or recommendations on this presentation. It is a general presentation, but hopefully the information that I'll cover today will help you make some informed decisions about your financial future. And be sure you consult a professional for advice regarding your own particular personal situation. Now, before we get into the agenda for tonight, we have a couple of poll questions just to see where people are in their process for planning for retirement. So let's go ahead and start with the first poll. The first one is, how many years do you plan to stay in the workforce?
Okay, and the questions that we have are, as Pamela said, how many years do you plan to stay in the workforce? And it looks like the majority of people plan to stay in the workforce less than 5 years. So we have some people that are doing great planning 5 years out. I hope it's great. Some folks 5 to 10, the next big group, and a lot of people neck to neck with 5 to 10 years are already retired. And there's a
Great.
small group that are really planning ahead. They are 10 years out. So the majority are 5 years or less.
That's great. That's good for those more than 10. This is some good
Yes.
information to get really started a little bit earlier, like you said. But a majority are within that five to less than 5 and 10 years. So the second poll, which best describes your current situation?
Okay. And it looks like we have neck to neck, almost neck to neck, government just eking out a little bit over private industry. We have then the next big group are retired and have no plans to work again. And the last group is are unemployed but looking forward to work. So neck and neck, Pam, tonight with government employees and people from private industry.
Okay, so looked like a good mix of people that we have joining us tonight. So we'll be talking about, of course, some programs that are specific to government employees, 403Bs, TSPs for government workers, and of course, private industry, 401Ks, and things like that. So thank you very much for your assistance, Opal, with the poll questions. So tonight, let's look at our agenda. I'm sorry, disclosures. Presentation, like I said, no specific financial advice. Make sure you consult your professional, and no acting on anything that's in here unless you do consult your professional. So tonight, we'll share information about the most important aspects of your financial health as you define your own financial goals. And you set your priorities, you prepare for retirement, and you take those steps that are necessary for your future. We'll provide information that will help you recognize the steps that you do need to take in order to prepare for a successful retirement, no matter where you are in the process with your finances. And to remember, your personal finances is just that. It is personal, and it is not a one size fits all. As such, like I said before, best to consult any professionals before you make any specific plans to what is in your best interest for you. ARP does provide a number of resources for you to refer to. We will be sharing a resources page with you at the end of the presentation, but throughout, I will also be mentioning some resources for you um, to refer to as you take your financial journey. And we'll cover many of those in this presentation, as I mentioned. Now, in this session, you'll learn about ways that you can determine how much money that you would need for retirement compared to how much that you already have and that you're on track to have saved for retirement. And of course, any strategies to bridge the gap if you do discover that there is a gap in your plan as you're doing that. Now, before I get started, I really want to set some ground rules. First, we want to make sure that everyone has an opportunity to share. There'll be some exercises that I'll be having throughout the presentation. So feel free to put any information in the chat for that. And also we'll be using the chat feature for any Q&A, but we will be holding questions to the end of the presentation. So we make sure we get as much information out to you as possible. And then we'll take questions at the end. Now, this is a judgment-free zone. So no question is a bad question. So feel free to ask what you want. And make sure that you're cautious that you're only sharing not sharing any personal information. Just share only limited financial information, just kind of general broad cases. We want to make sure that you're not sharing any personal information in the presentation. Okay. So before we get started, I really want to go through, like I said, one of these early exercises with you. Now, as you get started, we want to do this quick warm up, really just to kind of get you thinking about today's topic about retirement. And the first step is in the process is really to visualize what kind of retirement that you actually want. Do you want to focus on a hobby? You want to travel? You volunteer, as we do here at AARP Virginia, spend time with kids and or grandkids, and then maybe even start a business or second act. So we're going to take a few seconds or so just to really write down a few words that come to mind when you think about your own retirement goals. And then we'll just kind of see what comes out of that conversation. And Opal will help me with that.
Well, Pam, we have one person that has told us that they want to travel and volunteer just like you and I. That's great. All righty.
Any others who want to share?
Okay. Another person said they want to travel with Andy Garcia. Oh, wow. I guess
That's
they do.
specific. That's a specific
That is
retirement
specific.
goal.
You have to let them know now.
Exactly.
All righty. Travel. Travel seems to be trending tonight.
Mhm.
Travel, travel, travel. And Andy Garcia is coming with us all.
I
Family
guess so.
reconnections. Yeah. Don't we just love that? Move to a warm place.
Mhm.
That's always at the top of travel, and time with our grandkids is very special now after these last 2 years. Volunteer, volunteer. Great.
Okay.
All right.
Yeah, well, thank you very much for helping me with that, Opal, and thank you guys for sharing as well some of those ideas because you know the excellent ideas that you have. This is a very valuable exercise. Retirement is actually beyond the money. We'll talk a little bit about, of course, how do you save for retirement, but really, what do you want the retirement to look like for you? And I do encourage you, even after this presentation, to do some more reflecting on what that's going to look like. I really like the Andy Garcia thing and anybody else who wants to have something else creative. But you want to consider writing down your choices and then really ranking them in the order of importance, being as specific as possible. Because what this will do is really help you to determine what matters most, of course, and then whether you'll need the same or perhaps even more or perhaps even less in retirement to really support the lifestyle that you want. So it's really a valuable exercise to do even after tonight. And I thank you very much for your participation. Now let's look at the first topic, which is determining what you would need for retirement. And that's always the big question. How much money will you actually need in retirement? It's a question that we ask ourselves all the time. And we're here to help you. Now we're going to walk through some steps and how you calculate how much money you're going to need in retirement for this section. We'll meet a hypothetical couple that is doing the exact same work that you're doing that we will refer to in this presentation as an example as you begin to make your own calculations. And at the end portion of this presentation, you'll be able to identify the resources that you do need to allow you to calculate your own projected retirement needs. And we'll be using the helpful and free tools through AARP. It's aarp.org/money for this section, which is the AARP Retirement Calculator. And the link, of course, is in the handout, and we'll also be dropping some links in the chat as we go along, but it will be on your resource page, so you'll have that. Now, after today's session, I do encourage you to use the tool for your own calculations. Now let's move over to our hypothetical couple. Now let's meet Pat and Ronnie. Pat is 55 and Ronnie is 52, and they've been legally married for the last 20 years. And as they calculate their retirement needs, Pat works full-time and earns a salary of $60,000 a year, and Ronnie also works full-time with a salary of $50,000 per year. They do both plan to retire at age 67 as they start to save, or as they are saving about 8%. That's about $8,800 of their income per year for retirement right now. Now they have decided to sit down and really figure out how much money they're going to need in retirement. And the first calculation they're going to need is really what is their current retirement savings? That is, how much money do they currently have in their retirement funds? And so let's look at how they're going to find that number before we move on in our calculations. Now, a common source of retirement income for most Americans is their retirement plan through their employer. Now, some of you already have these accounts while others may not, and that's fine. Not everybody's going to have the same resources. But the most common kind of employer-sponsored retirement plan these days are your 401k, your 403b, as I mentioned, with some government, state government employers and teachers and things like that. And of course, we had some government workers on the call. That would be your TSP. Now, they're often referred to or described as defined contribution plans, which means that type of retirement savings where employees contribute a fixed portion of their income to fund their retirement. Now, in defined contribution plans, the onus is on the employee to make any decisions in order to take action for that. Now, they decide whether to enroll in the plan unless they're automatically enrolled, which is increasingly common practice these days for particularly larger employers, which is basically an auto enroll and you have to opt out. So it's more of a you're in until you're out type of situation. And employees decide whether to enroll, how much they're going to put up their paycheck into their retirement plan, and then how they're going to invest those assets. Now, one tip here, if you do have any of those types of accounts, you also want to look at your current portfolio, ensuring that you are getting the maximum and matching funds from your employer if they are available. Now, the less common type of employer sponsored retirement accounts are your traditional pensions, which we call defined benefit plans. Your employer funds the plans, and then once you have met certain criteria, usually the number of years that you've worked, typically 5 or more, when you retire, you will receive a specific, basically defined benefit amount every month as long in retirement for as long as you live. Now, we had some government employees on the call. That would be your FERS, your CSRS. That would be defined benefit types of plans as a pension. Now, we'll also discuss employer-sponsored retirement accounts, non-employer sponsored accounts such as IRAs and Roth IRAs in depth a later part of the presentation. But if you currently have them, you should be sure, of course, to include those as well, along with the other types of plans that I just mentioned in your calculations for the amount of money that you currently have saved up for retirement. Now, let's take a look at Social Security benefits, because Social Security benefits is going to be a huge part of your retirement income. Now, for most of us, Social Security is really, like I said, an important part of your retirement picture. And then deciding when to actually claim is a big decision. The amount of Social Security that you will collect over the lifespan really depends on the lifetime of earnings. And this is usually the highest income over 35 years. And that's the age that you start collecting and the number of years you collect your benefit. So we've probably heard of having 40 quarters, basically 40 years of service before you are eligible for Social Security. They take the highest income over those 35 years. So they're going to knock off the 5 years in the beginning, maybe earlier in your career when you got first started. Mine was working at Six Flags. They're not going to count all of those low earning jobs that you had earlier on. They're just going to really focus on the highest income over the 35 years. So when you claim, it's very personal and very important decision for you. Now, if you are married and you both earn a benefit, Social Security will compare your own benefit to the benefit that you collect on your spouse's record, and then they will pay you the higher of the two. So if you had a spouse that may have been out of the workplace for a certain period of time and may not have either the quarters and or may have lower earning years, they will look at which one is bigger, and then they will give you the higher of the two. Now, you do qualify for Social Security by paying into Social Security tax on your earnings while you're working. That's that FICA that you see on your pay stub. You and your spouse do need to have worked, like I said, and paid into Social Security for at least the 10 years in order to be eligible. Now, you also have survivor benefits, there's spousal benefits, there's disability benefits that are paid out through Social Security, and all of those have their own qualifications and criteria. Now, you want to make sure you refer to the AARP Social Security Resource Center for more information. Again, the link is going to be in your resources page on the handout you'll receive after the presentation, and we'll also drop that into the chat as well. Next up, we're going to explore why it pays to wait. Now, let's take some time to review information that can help you make your best decision for you in regards to your Social Security benefits. When it comes to claiming Social Security, you have choices that will impact your benefit. Now, one option is to consider waiting to claim in order to increase your monthly benefit amount. You'll receive your full benefit amount at what we call your normal or full retirement age. Now, that is somewhere between 66 and 67 for most people. Now, that is actually depending on your birth year. So you've probably seen on your Social Security statement 66 and 2 months, 66 and 4 months, so on and so forth. And so that's how they determine that. Now, also you choose to receive a benefit as early as age 62, but your benefit is reduced by 25 to 30%, depending on your full retirement age for the rest of your life, for as long as your survivor claims them. So it's really important to consider how this decision will impact your family and not just your own benefits when you do claim. Now, you also want to make sure you can also delay your benefits beyond the full retirement age. This will increase your benefit amount by 8% a year up to age 70. So it really pays to wait. Now, if you look at the chart that's here, the chart on the slide shows you how claiming age can impact the benefit. Now, Pat's full benefit is $2,157 per month for his full retirement age at age 67. That's shown there in the pink bar labeled 67. Any benefits received earlier, as you can see, are shown in the pink and the red, that's age 62 to 66, are reduced, like I said, usually by the 25 to 30% of any benefit. And then after age 67, you can see in the pink and the purple, that's age 68 to 70 plus, you can see how that's going to be higher. Now, if you have not yet created your own Social Security account, I suggest you go to ssa.gov/my account. You can view your personalized version of your benefits outlook from my SSA. My SSA. You can calculate your expected payout, apply for benefits, and then monitor your Social Security news and updates. Again, we're going to add that to your resources page. You'll have the link in order to go and do that. Now, depending on when you claim is a personal decision that only you can make. And remember, though, the impact of your claiming age isn't just with your retirement benefit. Really consider how it's going to affect your survivor benefits of your spouse when you receive it, if your spouse outlives you. So make sure you make that decision together. Now, next up, let's take a look at what Pat and Ronnie will receive for Social Security. Pat and Ronnie plan to retire, as I said before, at age 67, which is considered by the Social Security Administration to be full retirement age based on the years in which Pat and Ronnie were born. Now, when they take the Social Security payouts beginning at age 67, they will receive, like I mentioned before, $2,157 for Pat, $1,890 for Ronnie per month. And however, they have also done those calculations to see how much they would receive if they had waited until they claim their benefit. And they found out just by waiting those 3 years to take it at age 70 versus 67, they were at 70, Pat will receive $2,675, and then Ronnie would get $2,344 per month. That's an increase of 24% just by waiting those 3 years. You can figure these numbers out yourself as well. So AARP does have a Social Security calculator, which can be found at aarp.org/Social Security benefits as well. So it does pay to wait if you can. Next up, we're going to consider your lifestyle and how it affects your retirement savings. Now, so much what I get is how much you're actually going to spend in retirement. So how much you're going to need, but also how much you're going to spend. Will you spend more? Will you spend the same? Are you going to live more modestly? Are you going to stretch your dollars further? That's all depends on a lot of different variables. Where you're going to live, cost of living is different in different areas. So how much you're going to spend really is a personal decision on what a lot of different variables. But the AARP retirement calculator makes an educated guess about your current lifestyle by starting with your current income, deducting your employment and income taxes, and then they subtract the amount that you're saving. Now, what's left is your current lifestyle figure. The calculator is going to assume that in retirement, you will need about 85% of that figure to live close to what you're currently living in the same lifestyle. Now, you will have, because of the expenses, hopefully, most people say that typically the expenses are going to be lower for retirees. This amount becomes your retirement spending goal, which it usually adjusts for inflation each year. And as we know, inflation is getting quite a bit higher these days. So you want to make sure you the calculator is going to factor in a certain percentage for inflation. You can adjust the amount of the lifestyle areas in the calculator just by selecting the retirement lifestyle, which is lower than, higher than, or the same as your expenses today. Now, think about if you have a more moderate lifestyle, assume about 75% of your current expenses. The more extravagant lifestyle, however, you want to look at 95% of your current expenses. The calculator will also allow you to key in any specific percentages that you want to take a look at to apply to your current lifestyle. And you do want to determine how much you'll actually spend in retirement. Just make sure that you're going to account for all of the potential expenses. Be as conservative in your estimates. It's better to have too much more than not enough. So be conservative in your estimates there. Now, Pat and Ronnie have compiled all of their numbers, and they can easily review where they stand just based on this chart here when it comes to their retirement goals. For Pat currently has 100,000 in a 401k, and then Ronnie has about 75,000 in a 403b. Neither of them will receive a pension, so they don't have a defined benefit plan. They just have defined contribution plans right now. All of their full retirement age, as we had stated before, is 67, and they will receive the $2,157 a month for Pat, and then the $1,890 a month for Ronnie in retirement. And they plan to live a similar lifestyle in retirement, which they've decided based on research, they've estimated about 75% of their current income. Now, they went and did this process themselves, and they used the AARP retirement calculator. And we can see how their retirement savings have spanned over the years. In the dark green is their net income after savings and taxes. And then the light green, as you can see, is their Social Security benefits. And then that gray area you can see in the chart represents the funds they will withdraw from retirement. And then you see that little bit of red in there is the amount of the shortfall that they have each year in retirement, if it exists. So we see in this particular case, Pat and Ronnie is beginning to run out of money at age 82, which is the same time Pat and Ronnie retirement savings, which, like I said, represented in the gray, are projected to start running out. Pat and Ronnie are going to have a shortfall in this calculation that they have about $38,177 if they make no adjustments or changes to their life-saving plans before they retire. So what can they do to bridge the gap? We're going to explore some of those strategies that can help you in retirement if you end up, as you're planning for your retirement, to see how you would be able to fill the gap. So if you do see a gap between what you would need and what you actually have, don't feel overwhelmed. However, know that you're not alone. A lot of people are falling short for retirement. And it's never too late to start saving and changing your course of action. There are many strategies that you can use to bridge the gap between where you are currently and where you hope to be. And so in the next section, we will discuss several steps you may want to consider as we look at the strategies. But before that, we have another exercise. And I'm going to ask you guys a huge favor before we do this. Like I said, I'm on the road and I'm traveling and I'm doing this presentation and I forgot to plug in my laptop. So while we're doing this, while we're doing this exercise, and Opal's going to fill those for you, I'm going to go grab my power cord and I'll be right back to you. But before we begin to look at those strategies, let's take a moment to consider a time where you wanted to achieve a goal that you had set for yourself. It may have been a big purchase or completion of a large project or accomplishment. And then what kind of what sort of planning did you actually have to do and required to reach your goal? And then what made you successful in reaching your goal? And then I will be right back with you in 2 seconds while Opal reads those for me.
All righty, no problem, Pam. We're looking for you to tell us how you set your goals, as Pam said, what things you are doing. So I'm looking for someone to put something in chat. I don't see anything yet. Well, write it down, do the research. Someone said they saved 20% for down payment for their summer home. Isn't that just wonderful? And I heard that writing anything down will help you to be successful at your goals. So that's great. 20% for a down payment of their summer home. Wow. Nice to have a summer home. All righty. Let's see. Is anybody else out there setting some goals for themselves that they'd like to share with us? Okay. All right. Start paying off all bills and closing credit cards. Paid off mortgage. Ooh, wonderful. Set milestones. Somebody's setting milestones and they're tracking it. Somebody else said that they write it down and they watched it grow and they wrote it down again. It made them feel excited that they would put their goals down on paper and they watched them as they chipped away at them. Excellent. All righty.
Those are really some great answers because we know statistically, if you write down goals, you're more than likely to achieve those as well. And I always share, my personal story as I was planning for additions to my home and getting contractors and hiring contractors and interviewing people. It takes some time, takes some planning. What do you want to get done? You have to get the specs done and you have to, start hiring people. It's a process in order to get to a particular accomplishment or project, to completion of a project. And there's a variety of different steps. So wherever you start and wherever you finish, there's a variety of different steps. So really planning that out in order to achieve success. So thank you very much for participating. And thank you guys very much for being patient as well, as I had to do a little shift there as well. So where we want to move now is really looking at some of the behaviors and qualities that you can transfer from these particular skills that you have by writing down goals and things like that, how it can transfer it over to your money saving goals and debt reduction strategies as well. Now, a great place to start when you have to bridge the gap for any future retirement savings is by strengthening your current financial foundation as it stands now. No matter what age or situation or any unplanned expenses and debt can be difficult to manage and may jeopardize any carefully laid retirement plan. In the section that we will go over now, we'll introduce best ways to budget, plan for any emergencies, and then how to reduce debt. These steps can help you stay on track to meet your retirement goals, regardless of any surprises that life may throw at you. Now, everyone here, I know, me included, probably knows what a budget actually is, even if you may not have actually created one. But what I'd like to really emphasize here is the importance of budgeting as it relates to retirement planning. Your ability to save more towards retirement is really dependent on your ability to manage money well. And budgeting creates a margin, the difference between what you have monthly income and then your expenses. lower your debt, and you save is a great first step. Now, many ways that are sneaky, that money disappears. Sometimes you have more month than money sometimes. And just to name a few, I know I'm notorious for this as well: late fees, banking fees, subscriptions. That's my nemesis, is subscriptions that I haven't canceled, and any extras that may be on your phone or your cable accounts that you no longer need. So this could be an area where you can start to free up cash flow on some of these things. By carefully monitoring any income and expenses, you could free up hundreds of dollars each month. I always do this exercise for myself towards the end of the year, beginning of the new year. Like everybody else, I also make New Year's resolutions. I'm going to do better, and I'm going to, have more money, and I'm going to budget. Um, and so I go through my budget as well and take a look at some things that I didn't cancel. Like I said, subscriptions is my nemesis. And so some things that I may have still running that I'm not using. I love music. So, the music streaming services, I have it a lot. So $10 here, $15 here, whatever the case may be. I was able to free up almost close to $100, $120 just by subscription services, dining out, and other stuff that I just didn't need. So really going through, carefully monitoring the income and expenses in your household. Now, your budget will help you plan your expenses and savings in advance. AARP does offer free online tools to really help you set up a budget. It's called the AARP Home Budget Calculator. The link, again, like I said, will be in your resources, and we'll drop that as we go along. So you'll have that. Remember, a budget is an awareness tool first. You want to guide, it guides your savings as well as your planning for retirement later. You may prefer to do kind of old school, different methods on and systems for budgeting. If you're into the spreadsheets, Excel spreadsheets, or you can even do, like I said, old school pen and paper and just write it down. My parents, I remember when I was growing up, had a green ledger and they just put everything out that way. Whatever tool you use, it's really a good exercise to do it. So either you do it electronic or on a spreadsheet. Some of the apps are good for that as well, or you do it old school pen and paper. Regardless, you want to make sure you create a budget, or at least have a sense of the income and expenses in your household. Now, let's think about any financial emergency preparedness. Just 39% of Americans, that's 39% of Americans, would be able to cover $1,000 emergency if something unexpected pop up. That is a huge number of people. And here's the issue. When we aren't prepared, what happens? We're likely to pull out the plastic in order to cover these emergencies, and that's not going to help achieve your goals, let alone retirement goals. For most people, the best place to save for emergencies is a no fee, low fee bank account with no withdrawal penalties. If possible, consider setting up an automatic savings options. If you could, set up a separate account where you have recurring automatic transfers that come in. If you're able to receive your paycheck, maybe do a direct deposit straight from your paycheck into one of these accounts. Consider putting that percentage directly into an emergency fund rather than your regular account. Financial planners like myself, we generally recommend about 3 to 6 months worth of living expenses in an emergency fund. For most people, that may seem like an intimidating number, but I always say, how do you eat an elephant one bite at a time? So the best bet is really just to simply start where you are, to build up a fund. Whatever you can put into it, it adds up, and you have a regular habit of saving. So really looking at setting aside some emergency fund for yourself. Now, if you are concerned about debt, and you're not alone, the share of households led by older Americans even carry a huge amount of debt, and it has risen steadily over the past 2 decades. So what's the best way to really get rid of those account balances down to zero once and for all? First, we have to plug the leak. You can't lower any debt by adding to it. Now, one tactic, I know it's drastic. Some people do, they'll put a credit card and they'll freeze it and they have it in a block or something. that's probably extreme. But one of the tactics that I recommend for the most part is really, if you don't need your credit cards, don't travel around with your credit card. So credit cards out of your wallet and in your purse will stop you from using it. You also want to remove the one-click payments and stored credit card information on these online sites that you use to really help you avoid temptation. You go to the online shops, Amazon and things like that. If you remove those one click, they make it really easy. Remove those, and it makes you cognizant of actually having to put in a credit card number. It maybe, you have a pause moment there. Next, you want to stick with the budget that you've just created. Now, two popular debt reduction strategies that's worth considering is a debt snowball, and or a debt avalanche. The snowball method really focuses in on eliminating those smaller debts, while the avalanche goes the other way, and it really the approach from doing the highest priority on the interest and eliminating debt that way. So they look at the highest interest rates down to the lowest interest rates, and that's how they devise the payoff. The snowball is the other way. They start with the smaller balances. Simply put, any method that you want to use, you want to take a look at which one do you want to do. Now, for the most part, the snowball allows you to, though you're not going to save as much on interest, it just gets you motivated, uh, paying off a little smaller balances as you go along. Avalanche method, however, may take a little bit longer time. You may have a little bit larger balances, and the interest really just going from the other way. It's kind of hard to see, and you may be less motivated to pay it down. Now, that's what most economists say because you do save money on the interest. However, it's just a longer term method, and it could be harder, like I said, to stay motivated just by using the avalanche method. I always recommend whatever method you choose, just be sure to stick to your best debt reduction strategy. And you want to write that out just like you do with your goals. You want to see how you're going to pay down your debt. There's a lot of calculators online. AARP has resources as well on really how to devise either a debt snowball or debt avalanche for yourself. Now let's move on to discussing strategies for increasing your retirement savings. Now we've discussed, of course, the importance of budgeting and debt reduction. Now let's look at how some of these resources regarding longer term savings. First, we want to explore your workplace options. Be sure that you're getting the maximum matching funds at your employer sponsored plans. Your employer may offer a match as long as you're able to contribute the minimum match. So if they put in three, you put in three, they'll match three. May want to make sure that you contribute at least the minimum in order to get that match. Through your employer plans, you can also set your retirement contributions for an automatically increase. So you get a raise, your employer sponsored plan gets a raise by a certain percentage each year. That will allow you to do and increase your retirement contributions as your salary increases. Like I said, you get a raise, your employer sponsored plan gets a raise. This is called auto escalation. It is available through most employers, but you want to make sure you want to contact your employer retirement account administrators and see if auto escalation is available in the 401k, 403b, or TSP plan that you may have. You also want to make sure you review your portfolio mix. There are several options that are available. One of the most popular ones are target date funds. You can adjust your portfolio mix from a less aggressive down to a more conservative strategy as you get closer to retirement, or you could do a moderate conservative or aggressive portfolio based on your risk tolerance to your retirement plans if you have them. Of course, as anything, you want to consider consulting your employer sponsored plan administration to learn about your investment options in your plan. And if you need direct advice, make sure you consult a financial advisor or financial professional to see how you need to be allocated. AARP has a number of resources in this area as well. The AARP has an interview and advisor tool. It is a free resource that helps you understand a financial advisor's credentials, how they're compensated, any tips on how to get the conversation started with the planner around your particular needs. The tool is available on a smartphone, your tablet, computer. Of course, we also put the link in for you in your resources page. Finally, if you're 50 years or over, you may be able to take advantage of what is called a catch-up contribution. That's additional money that you could put into deposit into your employer sponsored plans for an extra 6,500 in 401ks and 403bs, TSPs for our government workers that are on the line. Next, let's explore your non-sponsored, your non-employer sponsored plans. There are individual retirement options that you can explore in addition to or instead of any employer sponsored options. Be sure to speak to a financial professional, of course, about your decisions before you do make them. Explore the Roth IRA. So a Roth IRA is an after-tax individual retirement account, though there are income limits that are phased out for any eligibility. So you want to check the IRS rules and regulations on where you are in terms of income and your eligibility. A great feature of the Roth, however, is that you pay on no tax on your gains, which you could take out qualified withdrawals. You can withdraw Roth contributions without penalty or taxes, as long as the money comes out from the contributions and not the earnings. There is also no required minimum distributions, or what we call RMDs, at age 72, contrary to the traditional IRA. Now, the traditional IRA, however, with the traditional, you get tax deferral on the money that you contribute, meaning you don't pay any tax as you go along when you make the deposit. However, on the back end, you're going to pay taxes on your contributions and gains when you take money out. So generally speaking, you will pay a tax penalty if you do withdraw the money before 59 and a half. That's kind of the magic number on any of these retirement plans. 59 and a half, when you get there, you're eligible to start taking money out without the 10% early withdrawal penalty. Now, when you take a look at either Roth, doing a Roth and or traditional, you want to think about, I always use the analogy, do you want your dessert now or you want your dessert later? If you want tax-free income in the future, then that may be dessert later versus dessert now, which is tax favorable treatment today, which would be the tax deferral. So either way, just kind of evaluate the dessert now or later. Now, these plans also do have a catch-up contributions for extra $1,000 into the Roth and or traditional if you're over age 50 as well. So they have the catch-up. With either of these options, again, you want to make sure you look at your portfolio mix, consult a professional if you do need it to make sure that you're allocated properly in your investments. Now, when you also preparing for retirement and employer strategies, the bridging the gap aren't enough, there may be other ways to cut back. These strategies really focus on making your lifestyle and adjustments and changes to meet your retirement needs. Now, before I move on to the cutbacks, I wanted to kind of share with you all as well, kind of a couple of different ways to think about your retirement. Think about your retirement in three different phases. We talked about current year lifestyle and what you're going to need in retirement. So in the beginning parts of your retirement, you'll have what we call the go-go years. So I heard a lot of travel and I heard hobbies and I heard a lot of different things. You may actually end up, we talked about 75%. You may end up having more or requiring more in those go-go years in the first part of your retirement. So you may want to consider the things that you'll be doing. Then you'll have phase two, which is basically the slow go years. You've done the things, you've done the travel, you've went traveling with Andy Garcia, you've done all of these things. You may be actually spending less in phase two. And then on the back end of your retirement, it'll be the no-go years, which is basically you're aging, you're not traveling, or you're not doing a lot of these things, but it could cost you a little bit more because now you have increased healthcare costs, long-term care, Medicare costs, refitting your home for additional things if you become uh, a little restricted in your home. So you could actually end up spending more, a little bit more in those no-go years as well. So you kind of think about it as a bookend when you're thinking about those three phases of retirement. Now, on to kind of looking at how do you make some cutbacks. We want to explore some additional ways to help you bridge your retirement funds gap. The question of when you retire is, of course, is going to be an important one. Generally speaking, the longer you work, the more money that you'll have coming in after retirement. And the longer you work also means working retirement years if you need to finance with savings. And also it allows you more years to increase any retirement savings. And also if you have a defined benefit plan, it could lead to higher pension and also lead to higher Social Security benefits. Um, it's possible to work longer, either in a full-time capacity, a part-time, maybe gig work. There's a lot of gig work out these days as a potential strategy to leverage. AARP does also have a resource, aarp.org/work, for some helpful information on resources on this particular topic on working longer and some of the things that you can do there. Again, refer to your resources page in order to take a look at that category. Another way to deal with a gap in retirement funds is to downsize. A lot of people are downsizing. However, I don't know, in this market, it's a little tricky with what's going on with interest rates and home values. But consider first, if you move, you have to weigh the move and you make sure you do a careful comparison. So if you do own your home and you stay put, over time, of course, your current house may need additional major repairs. You end up having to pay extra property tax, even though you may have your mortgage paid off. By contrast, if you do move, you may have to fix up an older house. If you also have the moving expenses, if you move from a house to an apartment, rent payments go up over time, which will gradually get higher and higher. Remember that you also want to keep, if you do keep your old house and bought a new one, taxes, insurance, upkeep have also risen as well. So consider those things as you think about downsizing. You'll want to maybe think about liquidating, selling some items online, selling things that are in your home that you don't use anymore. Remember to be realistic if you do sell things, what the selling price is, because they are used goods, whichever, there are a lot of different apps that allow you to basically sell any unneeded items. Whichever apps you use, make sure you are careful to protect your any personal information. Communicate only through the app. If you don't want to give out any personal information like your actual address, your email, your phone number, any of those. And if you do choose to meet in person to meet a buyer, make sure you do it in a public place, a coffee shop or a police station or any public place that you feel comfortable. For additional strategies for bridging the gap, we want to make sure you look at the AARP ACE Your Retirement. Again, the link will be on your resources to handout page. Now let's get back to our couple, Pat and Ronnie. Let's see how they fared in retirement with their retirement planning. The AARP calculator, so they went and used the AARP calculator, and Pat and Ronnie discovered that, remember, they had the shortfall of $38,177 if they didn't make any changes to their retirement plans before they retired, as they initially considered when they each turned 65. So they were looking at 67. So what did Pat and Ronnie decide to do? First, they took some of these, they took the AARP retirement strategy workshop, and they decided to create a budget, allowing them to see the difference between what their monthly income and expenses, which is called the margin that I talked about before. Their margin allowed them to build that emergency fund, your savings account, and that prevented them from accumulating any extra debt or tapping into their retirement plan for any expected, unplanned expenses. Next, they decided to tackle their credit card debt, and they decided to go with the avalanche method. So they went and they listed all of their balances from highest to the lowest interest rates, and then they decided to go ahead and start paying those off over time. Pat and Ronnie found it, whatever they were able to after they have paid off their debt, they were able to build an emergency fund and then allocate that margin each month to paying off their credit card debt. Finally, what Pat and Ronnie also decided to do is that they said, okay, 67 may not be the age for me. Let's go ahead and look at age 70 as a retirement date instead of 67. And just by those 3 extra years, as we saw before with that shortfall, now they were able to have a surplus of $163,840, as opposed to that shortfall that we saw before. Now, of course, these strategies won't work for every situation. As I explained to you at the beginning of this presentation, it's personal financial planning, personal retirement planning. Each person's situation is going to be different. But Pat and Ronnie, they were pleased that they had did the planning, and they're really optimistic about their retirement plan. You want to be sure that you use the resources from the presentation that we shared to create your own retirement plan. As I said, this is really a process, and I commend those people who are really starting more than 10 years out, because it is, a strategy to look at over time. Now, before we end, I think this is the time where we're going to jump into some Q&A and have some fun with you guys. So who is fielding questions for me?
It's me.
Yay!
Pam, the first question is, with regard to receiving an ex-husband's Social Security benefit, is there a maximum number of divorced years that pass that might make this individual ineligible to receive? Can you answer that one?
This is an ex-spouse, right?
Ex-spouse.
Okay.
The individual asking has never remarried.
Got it. Okay. Those are the rules. You basically cannot be remarried. You need to be at least age 62, and you need to have been married for at least 10 years.
And what about the space between retirement and the divorce?
There's no space between the retirement and divorce, but
There's
you just
no
need to
time
meet
limit.
those. You just need to meet those criteria. No remarriage, at least age 62, married for at least 10 years. Then again, as I mentioned before in the presentation, Social Security Administration will look at the ex-spouse's benefit amount, what they call spousal benefit, is that if that amount is higher than your own record, they will give you the higher of the two.
Okay. Do you have perhaps 1 or 2 recommendations for how one can plan ahead for inflation and stock market declines?
Yeah, that's going to be a tricky one. For the most part, inflation has generally been running about 3 to 4% on average, kind of historically. We're in an environment where things are a little bit higher now. So, when you do the calculator through AARP, you may want to maybe use a higher inflation projection to see what that may look like for your retirement savings as well. Regarding the stock market, there's ebbs and flows. As long as you have a properly diversified portfolio, you would probably, be able to weather the storm. But again, like I said, really consulting your professional, your financial professional, to see how your portfolio is allocated, to see how you can, perhaps weather the storm a little bit more.
Okay. Is there a maximum amount that one can contribute to their 401k?
Yes, it is. Depending on the age of the person that asked the
Individual is
question.
age 60.
Okay, then that would be allowing to do the catch-up contribution as well. So I believe max fee this year would be, with the catch-up, about 27,000 that you could put into a 401k, 403b, TSP.
Okay, I saw one. Can you age out of Social Security or things like a 401k, an IRA, a Roth IRA? I if I understand it correctly, I think she's saying, can you outlive your benefits?
For Social Security? No, no.
Okay,
It's a lifetime benefit.
all right, let me switch back to questions. How can I find out the increase of taxes if I take withdrawals?
Did they specify which retirement?
They're not specifying a retirement plan.
Okay.
Maybe I can ask them to specify a specific retirement
that's
plan
okay.
and I'll come back to it.
Yeah, can you repeat the question so I can make sure that I
Okay,
understand
the
it?
question as it is now, oh, she's clarified, from
Okay.
annuities. How do I find out the increase of taxes if I take withdrawals from an annuity?
You will probably want to consult your tax professional, but for the most part, annuities are more tax favorable. Ordinary income tax on gains, so it's a different tax treatment as well. But like I said, I'm not a tax professional, so you would have to consult your tax professional as well. But when you have the income from an annuity, most of the time it will go on your tax return, and then whatever your adjusted gross income based on that. But again, like I said, consult your tax professional, but annuities do have a little bit more preferable tax treatment.
Okay. At retirement, can you collect Social Security, pension, and 401k?
At retirement? Yes.
Okay,
Yes, it's part of your overall, as we had mentioned here in the presentation, your retirement income, all of those
Okay.
different pieces. Think of your retirement, if you have them, traditionally a retirement should have been traditionally a three-legged stool. One would have been your Social Security benefit, the second one would have been a pension, and the third would have been kind of your own savings, 401k, 403b, whatever the case may be. A lot of times people don't have that third leg, the one of the second leg, which is a pension. They only have two, so their
They only
retirement
have-
plan is a little wobbly. But yes, that would be your retirement income.
Okay. This individual is retired, age 67, not currently working, is planning on delaying Social Security until age 70. Does Social Security increase since they are not still contributing?
You would have to check on your statement, but for the most part, whatever benefit you have at the time that you stop working and you're not contributing anymore, it's not going to grow anymore.
Okay. Going back to the scenario of the individual that is divorced, not remarried, would their ex-spouse's benefit be half or a full benefit?
It would be half.
Okay.
Let me go
That-
back, Trudy, to clarify the question about the Social Security one. It wouldn't grow anymore, but between age 67 and age 70, it's an increase of about 8% if you don't take it at 67. But whatever that benefit is, so though you're not going to be contributing anymore, though you're not taking it, it grows by about 8. It's what they call extra earned credits between 67 and 70.
Okay. I'm going back to to my divorced spouse
Okay.
again. Sorry. Is that based on their retirement age or the ex's retirement age? Is
I
that a
would assume
factor?
yeah. So if the person who's asking the question, their ex, it's based on their earnings, the ex's earnings,
Okay,
whatever half of that is. So like, again, they were going to, Social Security will determine the higher of the two. So if the person who was asking the question, if their record is higher, then they won't get the spousal benefit. It's not like a combination. You'll get either or.
okay. And does that affect their ex's benefits at all? Does the
Not at
X
all.
get less money because you're getting a percentage?
No, that's actually the benefit of Social
Okay.
Security. Has nothing to do with the ex-spouse's record, or if they got remarried, the new spouse's record. It's a whole separate pool of money.
Okay. I think I'm going to make this our last question, Pam, because you and I are getting a little too involved in somebody's life here. What if there's more than one X? Can you claim benefits on more than one X?
No. So you have to, I guess, pick one of them. Whoever had the
one
most.
that made the most money would be
Whoever
the
had the
thing to
most.
do, right?
Exactly.
Okay.
Yes, you will only be allowed one spousal benefit amount.
Okay.
Any other questions?
Let's see. That was it.
There's Pip, Trudy, there's one in the chat box.
I see it, and it's I'm wondering if it's a little too personal. We've got time, so Pam, I'm gonna ask it anyway. Okay.
Okay.
If you have worked in industry for many years, then early retire without electing to receive Social Security and choose self-employment like a consultant for some years, with the salary selected for Social Security benefits be based on the last 3 years when they worked in an industry, or the self-employment years?
Mhm. It's kind of a combination. So if there's contributions to Social Security, even with the self-employment, that amount would count towards the Social Security benefits.
Okay.
Yeah.
And I am going to leave it at that. I think I have addressed everything, and I'll ask Opal to come back and join us.
I actually have to, I got ahead of myself, so I do need to do this conclusion and then I'll kick it back to
Okay.
Opal. So I'm glad that there was some very interesting questions, and I do appreciate that as well, because this is what this is all about, is getting information on retirement planning and where does that fit into your own personal situation. So I appreciate those questions. But finally, of course, after thoughtfully planning for retirement, building your nest egg, I do have to share with you some areas that you need to be considered to protect your assets. One aspect is really to protect yourself against fraud and scam. AARP has a wealth of resources to empower you with that. You want to visit the Fraud Watch Network to learn more. Again, we're going to put that link on your resources page. You can sign up for watchdog alerts. We'll notify you of any latest scams, any fraud tactics. And if you do know of anyone that has been fallen victim to scam, or you yourself, there is the free helpline to provide you with, can't speak tonight. And that will be also in your resources as well. Remember, you want to reevaluate your savings and review your plan at least once a year. Once you get it in place, you want to make sure you also partner with your spouse. Don't keep anybody in the dark. Make sure everybody's privy to all of the household financial information, especially as you start to plan for retirement. What I see a lot of times is people forget about, 401k here, or they may have a pension and may not. So just make sure everybody has access to the information. Now, I hope you enjoyed today's session. And so we reviewed, let's go over a recap, ways to determine how much you would need in retirement compared to how much you've already saved. And of course, any strategies to build a gap if you discover that there is a gap. So with that, I'm going to kick it over to Opal to close us out.
Well, thank you so much, Pam. Divorce seemed to be looming large tonight. So we all probably were taking notes just in case, you never know. So on behalf of AARP Virginia, I'd like to thank you for joining us this evening and express our gratitude to Pam Sams for sharing her valuable time and expertise with us this evening. I think we all learned a lot. Every time I listen to one of these, I learned something new. So I recently read an article myself that 50% of Americans spent more time planning for their retirement or preparing financially for those unexpected life events like divorce. So I'm glad you chose to be the other 50% tonight. As Pam said, eat that elephant one bite at a time. So and maybe you don't know, that one of AARP's North Stars or guiding principles is to provide information on how to make aging affordable. So I think what we learn here tonight really puts us all on the right track to age gracefully without the added worry of, will I be able to afford to grow older? So now we'd love to get your feedback on our program. In the chat box, you'll see a link to a survey. Please click on that link. Take a few minutes to share your feedback with us, and we'll also send this link in a follow-up email. So if you enjoyed the program and want to join us again, we'll be offering this seminar in the fall. You can get the details of that program and all of our upcoming events by visiting our calendar of events at www.aarp.org/virtual-VA. Again, that's aarp.org/virtual-VA. Until then, we encourage you to continue thinking about and planning for your secure financial future. Have a wonderful summer and spread the word. We'll be back in the fall. Thank you. Bye-bye.